So this is the third video of this series. I can say that in this video you will make a model, a three statement model starting from scratch. You will follow the four steps which I told you in the previous video. So if you haven't seen that video, I'll urge you to watch it first and then come over here. Also, I'll urge you guys to do it alongside me. So what you will need in the first step, all those assumptions we are going to take first. So as the first step was EBITDA forecast, we are going to talk about revenue first and then we are going to talk about costs. So what essentially we are doing here is we are making a bus model, a model where we have one bus which is covering 4 trips in a day and we are working for all the days, 365 days. There are some seats and number of seats in the bus and the price per ticket can vary depending upon the distance. So we are taking Mumbai Pune where the distance is around 155 kilometers and we are going to take those assumptions and you can take your own assumptions. That is why we say that this is a model. Why? Because assumptions can change and if you change those assumptions your complete model is going to change as well. So please follow along. So this will give you the revenue for the first year. Growth, because I need to forecast the revenue in price per ticket. Number of buses will be 1, number of trips will be 4. So let's see the cost. What is the biggest cost, guys? Fuel cost. So I'll use these three to come up with the cost. Growth in fuel cost per liter. Where you are actually getting into the business, thinking about it, thinking about what to include, what not to include, and understanding the assumption sheet completely because you are making it on your own. Okay, the first is fuel cost. Second is, okay, so will we take driver cost per trip? So we have to decide while you are taking assumptions that what are the units. As a businessman, what do you think? Again, total cost per trip, total cost per trip. And we have all the assumptions for EBITDA. What all assumptions we have? We have revenue assumptions, we have fuel cost assumptions, we have maintenance cost assumptions, driver cost. I'm saying this is my income statement. In bracket, I'm saying all numbers in INR lakhs. So price multiplied by quantity. Quantities will be derived using how? How will be the quantity derived, guys? That is your revenue. I believe, guys, you should pause the video here and you should try to do it on your own. Try to find the logic why we are multiplying so many things. And if you are stuck, then you can post your question in the comment section and I will respond to it personally. Please try to complete it till EBITDA forecast and I'll see you there. Only one thing is growing, right? Price of the ticket is growing. Quantity is not growing. We are not growing the quantity. We are not increasing the number of buses or we are not increasing the occupancy rate as well. But we can, right? The fuel cost per liter and then how many liters you want? 31 liters I want or 31 liters, right? Because for going 150 kilometers, 155 kilometers, I need 31 liters and then multiplied by 365. Should I include number of trips as well in this? And then divided by 10 raised to the power 5. That is what you get. And you can grow it. You can grow it using this assumption over here. That's what you get. Okay, let's wrap it up. Hi, please pause the video here. Now you can compare your EBITDA with my EBITDA. Is it matching? If it is not matching, please don't move on. I didn't show you driver cost, miscellaneous cost, toll cost in much detail, but I am sure that you can do it on your own and you are a hustler, right? So you can try and find EBITDA. If it is not matching, please let me know which element is not matching and I'll help you in the comment section below. Done. Can you guys go ahead and make a fixed asset schedule? So I'll just copy this part and I'll paste it here and I'll say fixed effect. So I'm saying beginning balance of fixed assets. So now beginning balance of fixed assets 0 and closing balance of fixed assets this plus this minus this. And then you can create a skeleton. You can say, okay, I will link it here. I will paste it ahead. I will paste this ahead. Now year 1 to year 4, I'm going to depreciate it, but I need some salvage value in the end. I need something to be left. So the depreciation amount will be how much? 70 lakhs. This minus this. This minus this. 70 lakhs. For how many years? 4 years. So I'll say 70 lakhs divided by 4. So just pay attention. I'll say 70 lakhs. That means this minus this and divided by 4. But obviously, I have to convert it into lakhs. So divided by lakh. And then I can say equal to this same so that I'm not required to fix it all the way and paste it. So I have just linked it to the first year's depreciation. You can have a look on this at this formula. It's a little bit of algebra there because we need to have some salvage value in the end, and we have linked it so nicely that you can see that the salvage value of 5 lakhs is coming over here. So depreciation rate, you can completely see that you can find out that depreciation rate from here, this, and that is on this. So you can actually go ahead and find that depreciation amount from here, that is 23.33. So we don't need a depreciation amount here because we have taken life of bus as our input. So if life of bus increases, then we have a little higher closing balance at the end. Because if we change the life of the bus, the depreciation rate will change along with it. So you might go for depreciation rate as an input, or you might go with life of bus as an input. I would like to go ahead with a easier input for me, which is easier to understand for me, and I can set my depreciation rate as I want. So maybe I'll not put it here because it's not an assumption. I'll put it here, which will go to my fixed asset schedule. What I've done is I've just found what is my depreciation rate in this case. So you will link that depreciation from this. That is EBIT forecast. So now we are done with EBIT forecast. That is our second step. I urge you to pause the video again, try to do it on your own. If EBIT is matching, then you can move on. Think about the next step. That is the third step, that is PAT forecast. For PAT forecast, what do you want? You want a debt schedule. For that reason, we will take some debt assumptions. So this, remember, this will not be an assumption here. This will be just 1 minus this number over here. So whatever comes here, for example, 40% debt, then it will become 60% equity. And if I say 30% debt, it becomes 70% equity. So remember that this number is not going to be a hard-coded number. So all those things which are hard-coded, I'll give them a format. Okay, doing this will help me distinguish a few things which are not hard-coded. So what I'll do is, please pay attention. What I'll do is select all of them. I'll go here and I'll just click on, say, this color maybe, and then click on this F4, select F4, F4. The F4 is used for this also, repeating the last command. So I am doing that formatting very quickly, and I'll not format 70% because I know this is not a hard coded number. Maybe we'll take more assumptions as we need it while we make a dead schedule. So maybe let me make it here. Then we have this, and then we can link the beginning balance to the closing balance. I can paste this, I can paste this, and my skeleton is ready. Now, debt raised will be 75% of 75 lakhs divided by converting into lakhs. So we got our debt, and we have, why we are doing this? We are doing this because we need to find interest cost so that we can come up with EBT. Then we'll go with tax amount, and then we can come up with PAT amount. That is the reason we are making a debt schedule. Depreciation was the reason why we made a fixed asset schedule. For depreciation, we need fixed asset schedule. For interest cost, we need a debt schedule. There are a lot more assumptions which has to be taken to complete this debt schedule and then compute interest cost from it. That can be, I can say it as EAI, uh, equal annual installments. So we are saying that we are repaying the debt in equal annual installments. So can I find the value of EAI somewhere here using the assumptions? What is the value of EAI? So what I've done is I have found EAI based on the assumption that in 4 years I am going to repay this loan of 56 lakh. But my work is not done because I need to find interest cost. Let's make it absolute. And then you can copy this, you can paste it ahead. Okay, I want to fix something before I paste it ahead, and then I can copy and paste. So I can see the interest cost is constant right now because we are not repaying the debt. Once we start repaying the debt, interest cost will, what will happen to interest cost? It will reduce. Perfect. Now what should I do with debt repaid? So we are doing 20 lakh payment in all these years, out of which this is the interest. So let's say what is the debt repaid at this in the first year? It should be, say I'm paying 20 lakhs. I should be fixing this 20 right now, and then minus this 8 lakhs, which is actually the interest component, which I'm not going to fix at all. If I fix that, it becomes a terrible mistake. So then I can paste it ahead. You can see wonderful things coming up that the closing balance has gone to zero. The debt repayment part is actually going up and up. Interest cost is going down and down. So this is one more way to make a wonderful looking debt schedule. This. So I'm so happy to link the interest cost. Okay, I can get EBT, that is this. We have EBT with us. We need one more assumption, that is tax rate. So I'll just take one single assumption right now, that is tax rate. Now we can go ahead and say maximum of 0 comma this multiplied by the tax rate which we have taken, and just fix it. Copy this, paste it ahead. Similarly, you can just copy this, paste it here. So are you happy? You are done with the first three steps. PAT forecast. You have completed the income statement. right? You have modeled the profit and loss statement. Now is the last step, that is balance sheet and cash flow statement. So we'll make a balance sheet first and then we'll make a cash flow statement. It is a fairly long process, it's not very small, but we don't have working capital in this business right now. That is the reason we will be making a very small balance sheet and a cash flow statement. Now let's move on to balance sheet and then move on to cash flow statement.
What will be there on the asset side? And that's it. And on the liability side, what do we have? What else? Total liabilities and equity. And then I have this tool called check. I can apply that. Just keep the cash value blank. Rest of the things you have to link. Fixed assets link it to somewhere. Think about it. Link debt somewhere. Think about it. And also try to link equity capital. Try to link retained earnings also. The closing balance of fixed asset schedule into fixed asset, linking the closing balance of debt schedule into debt is the first step which I did. I was very comfortable doing this. I may go ahead and actually, compute my equity capital, that it should be 25% of the bus cost, and just I'll convert it into lakhs. Okay, yeah, that's my equity capital, which is going to remain constant because I'm not investing anything else. So done till here, fixed asset closing balance, because balance sheet is made at the end of the year. Debt closing balance sheet is made at the end of the year. Equity capital is constant as it is cumulative. If you invest more during the future years, it will go up and up and up. But as we are not investing, we are just investing one time. We are just checking it as a project right now. So we take it as constant. We say there's no more investment done in the future. There is a part called retained earning. What should I do? To go down to the pad, and then I can just paste it ahead, and I'll get this as the check amount. Okay, so let us quickly complete the cash flow statement as well. So should I say pat, add depreciation? If you want to add interest cost, and then changes in working capital, which is not there, no working capital. So I'll just go ahead with CFO, that is cash flow from operating activities. Then CAPEX, that is cash flow from investing activities. And then we have equity raised, debt raised, and debt repaid, and interest cost. We will add debt raised because cash is coming in. We will reduce debt repaid because cash is going out. And also we will reduce interest expense as we are considering this as cash flow from financing activity. Okay, pay attention. Linking PAT to income statement, depreciation to income statement, interest to income statement, and CFO will be sum of these three. If you want, you can paste it on the left hand side also. So there are no operations in year zero, so no cash coming from operations. But the capex is done, and you can find capex from the fixed asset schedule. That okay, this is the amount which is going in as an investment, that is a capital expenditure. So you can say it as negative of this. Now, equity raised, debt repaid, interest cost. Okay, I need something more because I want to link equity raised to equity capital, but I don't have a column here. That is the reason I want to add one extra column here. You'll understand why I did that. It's a dummy column. I did that to link to the balance sheet. Equity raised, that is the change in equity. Equity में change कितना हुआ? Equity capital is this minus it was this. So that's the change. And we get it properly that okay, in the first year we are raising something and then we are not raising anything at all. Debt raised, you can directly link to the debt schedule. Here is my debt schedule, here is my debt raised. Similarly, debt repaid can be linked. If you want, you can link it with a negative sign, and interest cost can be linked here itself. You can link it with a negative sign if you want. CFF will be nothing but the sum of all these numbers, and cash will be cumulative as well. So I'll say beginning balance of cash, add cash generated during the year, that is CFO plus CFI plus CFF will give you closing balance of cash. Beginning balance of cash will be 0, CFO plus, please pay attention, CFI plus CFF, and then closing balance will be this plus this. So I can simply say,
So I stop this video here. You have to copy the year 0 completely and paste it till year 4, right? And you can do that. Once you have a closing balance of cash, you have to link that closing balance to balance sheet. You must have noticed that every element in the balance sheet is linked to the closing balance. So why not cash? Cash will also be linked to the closing balance of cash. So I leave it up to you to copy this and paste it till year 4. Find the closing balance of cash, link it to the balance sheet, and tell me in the comment box if you are able to match the balance sheet or not. If you are not able to match the balance sheet, I will help you personally in the comment section below. So please do not hesitate and comment as much as you can. Please share this video with your friends whom you think would, be benefited from this video. Thank you guys, and I hope you liked the series of these 3 videos, and I am looking forward to come up with the intermediate series soon. Thanks.